The information in this recording is general in nature and should not be considered personal advice. Please consult a professional and qualified financial advisor to discuss how this information may apply to your personal circumstances. Thanks for listening.
Hi, Dane Pymble from Own Financial Planning here, and joining me today is Julian Moore, Business Development Manager with Van Eck. And today we're going to be talking a little bit about the global real estate market and the opportunities that exist there, and then a little bit more broadly about Van Eck's suite of exchange traded fund products. So over to you, Julian. Tell us a little bit about Van Eck and global real estate.
Yeah, thanks, Dane. Thanks for having me on, and thanks everyone for joining today. As Dane mentioned, today we're going to be covering through Van Eck's global real estate ETF exposure. And yeah, that's a strategy that's currently being utilized within the sleeve in Own Financial Planning's portfolio. So I thought it'd be worth kind of running through that. Before we do get into the case for including global global real estate within portfolios, I thought it'd be good to just give you a bit of an intro in terms of who Van Eck as a business are. So Van Eck, we're a global investment manager. We've been around since 1955, and we're headquartered out of the US, but we've got offices in all key financial centers globally. We actually started life as an active management business, but it was in 2006 that we launched our first ETF, which was GDX, our gold equities ETF on the New York Stock Exchange. And now globally, we manage about 100 billion US in investor assets, across both active and passive management. But the bulk of that is now in the ETF business. And locally, we manage about $18 billion on the ASX, which is across 42 different funds. So that's across all asset classes, be it broad-based Aussie equities, international equities, some more sector-specific exposures like we're looking at today with global real estate, alternatives and fixed income. So it's a broad opportunity set where investors can kind of pick and choose what they're most suitable in terms of what their investment needs are. But yeah, I guess bring it back to today's topic, global real estate. I think it's important to first understand kind of why global real estate. And so, what global real estate offers investors is the opportunity to access commercial real estate market with the added liquidity, transparency, and regulation associated with investing in publicly traded stocks. Because if you think about, if you're going to buy real estate, there's typically a large capital outlay required in terms of the deposit required. But by being listed, that is alleviated, getting access to the real estate market. The benefit of global real estate as well is that it provides diversification with low correlation to some other traditional asset classes like equities and fixed income. It has the opportunity for high total returns over the long term. And there's also inflation management, as typically rents have a CPI or inflation link that sees rents increasing as inflation increases. If you think about liquidity, global listed real estate is a lot more liquid than regular real estate, and you can easily convert that into cash on exchange. And then there's also a lot of transparency in terms of the regulatory environment and the stock exchange rules governing how those businesses operate. Typically as well, one of the benefits of real estate is income, paying a high income yield relative to other asset classes like global equities. And so, that's another consideration for investors, why you should include that within your portfolio. Now, if you look at, why you'd want global real estate as opposed to just Australian real estate within your portfolio or listed global real estate versus A-REITs, so listed Australian property, is that diversification story. And from a global real estate market, if you look at the benchmark, you're getting a lot of diversification across countries. If you look at the breakdown, 60% of the global real estate market is in the US. Naturally, global equities have a high allocation to the US across kind of all exposures generally. But then you're also getting about 10% to Japan, 6% of Australia represents in the global market, UK, Singapore, Hong Kong. So it is more diversified than if you are just investing locally. Now, if we were to compare, investing in the Australian listed real estate, A-REITs, compared to global REITs, the diversification story is pretty pronounced. And so in the Australian S&P ASX 200 A-REIT index, there's 21 companies The largest constituent is Goodman Group, which is about 38% of the total portfolio, so very concentrated. And the weight of the top 10 stocks represents 88% of the total portfolio, and that's just from the one country being Australia. So it's pretty concentrated, that market. Whereas if you look at the global market ex-Australia, there's over 300 companies in that index. The largest constituent weight is only 8%, and the weight of the top 10 is only 36%, and that's across 21 countries. So really, you see that by investing in the global real estate market, you're getting significant more diversification than if you're just investing in the one country via Australian property. And also, if you then look at, I guess, the correlation of REIT, which is the global real estate ETF that VanEck offers, relative to the ASX 200 and also to the MSCI World ex Australia index, so like Aussie equities and international equities, it has a lower correlation. So that provides further diversification benefits to investors across their portfolios. Looking at it on a broader term, we can also look at it on a correlation matrix perspective to other asset classes. So looking at it compared to bonds, be it Aussie bonds, global bonds, global infrastructure, and you can see that from this table that we're probably going to display on screen here, that correlation is a lot lower. And so again, that highlights the diversification benefit of including something like this within your portfolio. Furthermore, from a risk and return perspective, whilst it's a bit higher up the risk curve with a higher kind of volatility than some other asset classes, it has also got quite a high return when you look at historical performance of the sector. And so that can play into an investor's total return profile. So then if we come back to getting access to global real estate, VanEck, as I mentioned before, offers the global real estate ETF, which trades under the ASX code REIT, R-E-I-T. And so REIT has been running in Australia since March 2019. And what it does is it provides investors access to currently a portfolio of 318 global property or global real estate companies that make up the index, which is the FTSE EPRA NAREIT developed ex-Australia rental index. And that's fully hedged back into Aussie dollars. So you've got no currency risk there. And the fund size of that fund currently is about $340 million. So, as we highlighted earlier, by getting access via, a listed property, you get that efficient access to the market with low entry costs relative to, taking access traditional ways that you would when purchasing property. And you also have that income and growth potential associated to the asset class.
Fantastic.
So, sorry, Dane.
No, you keep going.
So I was going to cover through, I guess, how the index actually works. And so if you look at the index construction slide, it does look a bit more complicated than realistically it is. But this just determines how we get down to that end portfolio of about 300 companies. And so the index itself, it starts with a broad universe of real estate stocks, which must be classified in a subsector as either real estate, heavy construction, or home construction. There's then a screen for earnings. And so in the last 12 months, full financial year, these companies must generate at least 75% of their total earnings, their EBITDA, from the ownership, trading, and development of income-producing real estate, which narrows our pool to 860 companies. We then screen for minimum size, end up with 485. And then the index then is the global index. We then go for ex-Australia and also only developed markets. And then finally, only including companies that are rental. And the reason for that is we exclude developers. And the reason we exclude developers is that typically, investors are buying this asset class of real estate for that kind of consistent income. And so, from a rental perspective, rental income is, consistent and frequent, whereas developers, typically have quite lumpy cash flows, so can have a bit more volatility in terms of where that sits in a portfolio. So our index only includes companies that are rental focused. And so we end up with currently 318. It's market cap weighted or free float market cap weighted, and then that process is reviewed on a quarterly basis. So if you look at the breakdown on a subsector side relative to an exposure of real estate in the ASX 200, you can see on the left-hand side of this slide here that the global real estate pool is a lot more diversified across those real estate subsectors, whereas the ASX 200 A-REIT index is very heavily concentrated in diversified REITs. So the benefit here is you're getting exposure to a lot of different types of REITs that are not accessible from an Australian investment perspective. And we're going to look at some examples shortly, but this can include build-to-rent housing, data warehouses, and the like as well. So, and these are not kind of areas you can get exposure to via the ASX. From a country breakdown perspective, currently, the United States is the largest proportion of the index at a bit over 70%, and then you can see there's coverage across other developed markets, be it developed markets in Asia as well as UK and Europe and the like as well. So now looking at some of those examples of some of the companies that are included. First of all, if you look at Simon Group, which is a US company that is involved in retail shopping malls. They're like a Westfield listed here locally. They're large in terms of their market cap is $51 billion US. And you can see that the dividend yield paid by that stock is close to 5%, so quite significant. And that's at 3.5% of the portfolio. You can look at Pluralogis, which is the next company. They're involved in supply chain logistics. Again, that's one of those areas that's not necessarily available in the Australian property market. So again, it's a different area to get exposure to. As is Vonovia, they're involved in build-to-rent housing. They're a German company, and providing that different access as well. Whereas Gencia is office and retail, which is primarily what you get in the Australian market. That's also a subsector that is included within the global space as well, naturally. If we talk about the performance of global property over the last couple of years, it has been impacted quite significantly, and the reason for that is what you saw over the last couple of years is that inflation cycle come through, and so with inflation, you saw interest rates tick up, and what global property gets labelled as is a bond proxy. Given that the way in which global property companies are valued is on their future cash flows. As interest rates rise, the value of those cash flows is reduced as a function of repricing, naturally reducing the overall valuation of those companies. So valuations have been hurt quite significantly. You also had some issues, I guess, around COVID with different companies working from home and the like. So you saw a lot of office vacancies, and so stock valuations have been hurt in the global space for property. But valuations are starting to look very attractive and cheap relative to historical levels. And given that long end interest rates and yields seem to have peaked and topped out, and we're now globally talking about cutting interest rates in developed economies, that could be a real tailwind for growth in this space, and you could see a real pick up in terms of the overall performance of this sector. So we're really positive long term. We think that global property is a core within portfolios that should be included, and definitely gives you that diversification and exposure to different areas that aren't accessible from a local perspective.
Fantastic. Well, some really great insights there, Julian. Thank you very much for sharing that. And if you'd like to learn a little bit more about how we utilize VanEck's REIT ETF in our asset allocation strategies, you can contact us at ownfinancialplanning.com.au. Thanks for listening.
Fantastic. Thanks for having me, Dane.
Thanks, Julian.